Hello all, this is David Rodriguez, quantitative strategist for dailyfx.com, here to say what is moving the euro to fresh multi-year highs, and just as, if not more importantly, can it continue higher? So let's dive straight into the charts. Right now what we're watching is simple. The euro is testing major resistance at these levels. 38.42 represents 61.8 Fibonacci retracement of the 2011 and 2012 decline, which is a big deal. We have closed above it. Another close, a weekly close above it, would further cement the case for the fact that the euro is retracing that much larger decline from around the 150 mark and is headed to fresh highs. Why is it doing that today? Well, there doesn't always have to be a fresh fundamental catalyst, and the real truth is that it looked as though dealers were sending the euro towards 139 because there are a big cluster of stops there. There was some talk about options expiration this morning, which roughly coincides with what should have been the options cut. So there were a couple of flow-based factors that were really driving the move today, but in truth, this is the direction that the market's been going in a while, and in fact, I see evidence that we can continue higher in the euro. And one of the things I've been talking about the most is what is the crowd doing? You hear me talking about this constantly. It's the FXCM Speculative Sentiment Index. It measures what real retail traders are doing. Well, we typically go against what the crowd is doing. In this case, the crowd has been short the euro since it crossed above 127, and here we are 1,100 pips later. So that kind of gives you a sense of what's going on. But what's more significant is that we recently hit a fresh record net short position, well, fresh record short position and net short position, which is significant. Now, nothing moves in a straight line, and the fact that sentiment is so one-sided warns that we could be near a potential turning point, as I've been talking about with the British pound. But in this case, traders have continued to sell into today's advance, so that gives me a sense that this could be a lasting move. There's definitely a risk of a pullback. Nothing moves in a straight line, but the euro looks to continue higher here. The one caveat is that FX volatility prices are very low. In plain English, it means that traders are betting on and hedging against relatively small moves in the weeks, months, and even year ahead. In fact, if you take a look at our daily FX volatility indices, they're near record lows. Those record lows were set just before the onset of the financial crisis. And you might say to yourself, well, we all know what happened after those record lows were set. So clearly, market conditions can't remain this quiet for that long. And you're absolutely right. But the real point is, until we see that kind of catalyst, until we see the impetus for the jump in volatility, it's kind of a fool's errand to try to pick the low. In plain English, I remain bearish US dollar because it's a safe haven currency that tends to do well in fast-moving markets. We're not in a fast-moving market. The S&P 500 continues on to record highs. I like being short dollar, especially against the euro, Swiss franc, not so much against the sterling or Japanese yen, but we'll see what happens next. So take a look at the charts. Best of luck trading, and I'll talk to you soon.